Assalamu alaikum warahmatullahi wabarakatuh. My name is Abdullah Bazzat. Today I'm going to do the presentation of my project paper, which is titled The Dynamic Relationship Between Exchange Rates and Stock Prices in Malaysia and Empirical Analysis using GOSH-11 model. The flow of this paper includes the conduct of unit root test, followed by the granular causality test to test the long-run relationship between the variables, then Johansen configuration test to check the robustness of the results from the previous granular causality test. After that, we investigated the presence of arch effects, and after that, the presence of the arch effects we selected the GOSH-11 model to conduct a study of volatility of these variables. We choose this GOSH-11 model as an extension of ARCH model, and it's known for its greater parsimony compared to the ARCH model, and also is less prone to violating the non-negativity constraints that are necessary for meaningful volatility modeling. And this is the equation for the variance equation for GOSH-11 model. This is the conditional variance, which is lagged at its own values, past values, and also the square residual of the lagged at its own past values and square root of residual. Running the square root, the unit root test, we've noticed that the data series for stock prices and exchange rates are found stationary at the first difference. When we found the at first difference, the ADF stats is -21, and for stock prices, and -21.7 for the exchange rates, and also similar to which result in rejection of homos, which proves that the data is stationary at first difference. Moving to the next one, this one is called granular causality. Granular causality test is used to test the causality in mean between the stock market prices and returns and the exchange rates. The optimal lag length we selected using the VAR model and based on the criteria LR criteria at 3 lags. The result indicates the unidirectional significant causality relationship running from stock market to the foreign exchange market in Malaysia, and there's no significant relationship going on the opposite side from the exchange rate market to the stock market. And this is presented in the below table here, where we found that the probability of stock prices does not granular causality for exchange rates is 0.03, which result to rejecting the null hypothesis. We accept that there is a stock price does granular causality foreign exchange rates, and here we can see similar that we do fail to not reject the null hypothesis that there is foreign exchange rates does not cause stock prices. After that, we conducted the Johansen test to make sure the robustness of the granular causality test. The tester rejected the null hypothesis of no co-integration, suggests that presence of long-run relation between the stock price and exchange rates. Here we use the eigen and trace values. We rejected the trace values is higher than the critical value at 5%, and also max eigenvalue is greater than 5, the value in here at 5%. We rejected the null hypothesis of there's no co-integration in this test, which results that there is a long relationship between the stock prices and exchange rates, which supports the evidence from granular causality. But there's for granular causality, there's no evidence that there is a causality relationship running from exchange rates to stock prices in granular causality. After that, the arch effects, we test the presence of arch effects, which were found that there's arch effects in both stock price and exchange rates series. That indicates that the volatility of stock returns in the Malaysian market, as well as the foreign exchange rates, were influenced by shocks from previous period. And we considered that there's arch effects does exist. The GOSH model can be used effectively to capture the volatility dynamic in both the stock market and foreign exchange markets. And here we can see the probability of the in stock series is 0.03, and for the exchange rates is 0.0011. Gosh, or while estimating gosh parameters alpha and beta are statistically significant at level 1% of 1%. This was the significance of this alpha and beta. This is the coefficient alpha and beta. Alpha determines persistence of shocks, while beta estimates indicate clustering effect in volatility. The persistence of stock in the volatility of exchange rates appears to be higher compared to the stock market index. Here we can see the value here is 0.16 is higher than 0.12, and for beta we can see the stock exhibits stronger volatility clustering effect than foreign exchange market. Here this is by the value of beta for stock price is 0.8, and for the exchange rate is 0.7. The findings and implication of our study that from GOSH 1.1 results, shocks in exchange rates volatility persist to a greater extent than those in the stock price index. And also the higher persistence of shocks in exchange rates suggests that fluctuation in currency, so traders and investors in foreign exchange markets and need to consider this persistence and the implication for their strategies. Additionally, the stock market demonstrates a more pronounced clustering effect in volatility compared to the foreign exchange market. Also, the stronger volatility clustering effect in the stock market implies that periods of high market volatility characterized by rapid price changes and increased trading activity tend to occur in clusters. Understanding this will help market participants to anticipate periods of the high risk and adjust their investment strategies according to those risk periods. And also the result from Granger test shows that stock market causes movement in foreign exchange market, supporting the portfolio balance model, and there's no Granger causality from foreign exchange to stock price to stock market price. This goes against the co-integration of Johansen test. The findings also enhance the understanding of relationship between stock price and exchange rates to develop more effective portfolio management strategies and assist trade-oriented companies in conducting risk. In our comments about the GOSH, the drawbacks or the shortcomings of GOSH model. The first one is this bad news and good news symmetrically, and while the impact of good and bad news on the market may be asymmetric, and this one can be used or fixed by using a GOSH model, which can be capturing the asymmetric effects. And another problem is the lack of clarity with regard to stationarity and presence, where shocks may persist in one norm but not in another in the GOSH model. For example, in some cases, shocks might exhibit persistent when measured in one norm, for example, volatility, but those shocks might not exhibit persistence in another norm, which is returns. That's all from me. Thank you so much for listening. Assalamu alaikum wa rahmatullahi wa barakatuh.